Hi, welcome to today's video and thanks for joining me. Today we're going to be looking at 5 ways you can deal with market volatility. I love doing videos like this because unlike say doing a video on financial planning or product video like life insurance or a type of investment, this is really about helping you to get through these times where markets are a little bit unpredictable or there's not a lot of clarity about which way the markets are going to go. So today's video is going to help you, especially over the next 6 months in the fall where we're a little uncertain about which way the markets are going to go. Now, if you're new to this channel, thanks for tuning in. My name is David. I'm an active advisor working with individuals, families, and business owners right across Canada. I've been doing this for more than 20 years. I create their financial plans. I invest their money. I'm also life insurance licensed, so I do all their life insurance, and I also help business owners teach them how to take money out of their businesses without paying any income tax. I love what I do. You can see the passion that I have for this industry. I like my career, and I think you're going to love my YouTube channel. The information that I have is pretty easy to go through, and I'm sure a lot of the things I talk about are going to resonate well with you. So enough about that. Let's get into why you're here today. Now, the North American markets year to date, look at this slide here. You can see the markets have really been coming largely from the US. So the NASDAQ is up over 35%, the S&P 500 is up over 14%, and the Dow Jones and the Canadian TSX kind of bouncing around the bottom all year long. And you know, if you are a Canadian investor, I know this is what this channel is really all about, you've got to be frustrated, right? Your returns have really not been rewarding you for being in the market. And you may have gotten out a little bit out of the US because you just were worried about what was going to happen in the US given all the interest rate hikes and so on. And so this chart is extremely frustrating because you want returns, especially on the heels of a few years where it's been really hard to invest money. So when you look at this chart and you have a look at one thing, I'm going to give you some insight as to how people gauge investing. And we're going to look at the VIX. The VIX is this purple line that you see that's below all the other indices. Now, I'm just going to move forward to give you sort of what is the VIX, and then we'll come back to this slide. So investors use the VIX to measure the level of risk, fear, or stress in the market when making investment decisions. Now, as a rule of thumb, when the VIX is greater than 30, that generally is linked to large volatility resulting from increased uncertainty, risk, and fears. But when the VIX is below 20, it's a signal to investors that, hey, go ahead and invest in the market because everything is fine. So let's go back to that slide. You can see it has an inverse relationship. As markets go up, the VIX goes down because people are basically saying, look, the market is strong, the economy is strong, it's time to invest. And so people generally don't have any fears. Now the VIX is forward looking. So this is what people are thinking, or the market is thinking 30 days ahead. So it's a forward looking indicator as to the temperature, if you will, of the market. And so now what you see is the VIX through June and July was real low, in fact, and markets were running up. But look what happened around August. The markets began to go down and the VIX began to go up. So that is like bang on a signal where people start to feel anxiety around which way the market is going. And that market is moving in that direction largely for a couple of things. The whispers on, or the speculation about what is going to happen with the Canadian interest rates and the US interest rates. Are they going to hold? Are they going to increase? They're certainly not going to decrease, that's for sure. So when people start thinking about if they're going to increase the market or the interest rate, that may have a negative effect on the stock market and on your portfolio. So people are saying, wait a minute, we've made some money here through the first short while of the summer months. Maybe it's time to take some of that profit off the table and just protect ourselves because maybe the news is not going to be so good going forward. Well, let's look at some of the 5 ways that you can invest during the times of this kind of volatility, okay? All right, the first insight is, it's easy for me to tell you this, but to remain calm. And it's really difficult for many people to remain calm. First of all, you have a lot of anxiety and concerns about just going into retirement for the first place. Like that is that's a difficult proposition for you to tackle right away. Is are we ready for retirement? Do we have enough money to retire? How are we going to pay for this, and this? And now you have to deal with the markets as well. So the first thing I would suggest is, or recommend, just remain calm. When you see the markets being quite volatile and you see the market drop, but let's say by 500 points, which is pretty severe, and we've seen it happen, right, many times, and you get worried about that, and so you decide to sell and get out of the market. And then the next day the market goes right back up again, and you think, what is going on? I just got out of the market. So it's very difficult for a lot of people. So the first thing I would say is remain calm and start that communication with your advisor. You can never make enough phone calls to an advisor. You really want to shake their tree and make sure that they're talking with you. So let's look at one thing that can really help us, and that is history. This is the S&P TSX. This is exactly what happened to the last three crises to the TSX. So let's look at the first one here, the dot-com bubble. That fell by 50%, and it took about 1,000 days for that collapse, if you will, to recover back to the previous amount before it collapsed. So 1,000 days, man, that is really hard. So if you're in retirement or just going into retirement and the market declines, that is a huge problem for you. And I've got plenty of videos around what to do before you get close to retirement. I talk about the retirement time zone. This is the first 5 years, or the 5 years before you retire, and the first 5 years of retirement. So there's a 10-year window where you really have to change the way you invest, because you really can't afford 1,000 days to recover. Then the global financial crisis was down 50%. Took 1,300 days to recover. But you see how that went. The decline was very sharp, and then it started to come back up again, whereas in the dot-com, it took just this gradual, slow rise back to the previous high. The global financial crisis scared the heck out of everybody because it was such a massive, quick drop that people were thinking, when is it going to, where is the bottom here? And it was really hard to deal with. Now you see the COVID-19, this was not so bad. And the difference between those other two financial crises is the governments around the world spent their way out of this. You can see, again, another sharp decline and then a sharp rise. And that is thanks to low interest rates and the government spending money. So it elevated everybody's assets to get back out. And then we thought, oh, we're in the clear, and now the markets are declining again. And quite sharply, you saw how the markets declined, and now they're just sort of bouncing around. So you've been through this before. You've seen markets recover, but the question is, where are you in this cycle when the markets are declining and recovering? Where are you? You have to think completely different about the way you invested money during your accumulation phase. This is you saving, investing, and growing your portfolio, versus your spending phase. We call this decumulation phase, where you're actually doing withdrawals. You have to invest your money largely completely different than the way you did in the accumulation phase. Now, do you see yourself in this slide at all? Do you see where it is where you get excited and you feel optimistic about the markets, and you get like everybody else is getting in, I've got to get in, this sense of euphoria, you buy, you get in the markets, maybe you add more money to the markets, and then the markets turn and you start thinking, oh, what a mistake, why did I do that? And all the anxiety and the fear set in. You get really kind of upset, and then you panic, and then you sell and get out of the markets, and the markets turn again, and then they start to go back up, and you wonder, why did I get out of the markets? This emotion that is carrying you through the way you invest, you got to try to not invest emotionally. Talk to your advisor, figure out a strategy that works for you, so that you can go through this phase of pre-retirement to retirement without having to experience all these ups and downs. All right, let's talk about the impact of being out of the market. This slide talks to you about the difference between staying invested even though the markets are going up and down throughout the year, versus trying to time the market when it's bad, get out and get back in again. So let's look at this. If you're in the S&P 500 as an example and stayed in the entire year, your rate of return is 9.8%. And if you had decided to get out of the market because for whatever reason, like fear and anxiety, and you missed 10 of the best trading days, then I mean, it's almost cut in half, 5.6%. Look at this box in the middle. It says 7 of the 10 best days occurred within 2 weeks of the 10 worst days. So remember when I was talking about when the market goes down 500 points and you get all panicked and you sell, but then the market goes back up and you haven't had time to like get back in, then you've missed one of the best opportunities, right? So this is the idea of market timing, trying to stay invested as much as you possibly can in the market. Now, volatility. Here's another way of looking at the returns of volatility and looking at short-term volatility versus the long-term. If you look at a 1 year, just the 1 year of any stock market, pick any indices you like, you're going to see the market really fluctuate. The stocks, the bonds, the 50-50 portfolio of fixed income versus equity, you're going to see these fluctuations where the market goes up and then comes down, sometimes 50%. But if you look here, that 1 year is really hard to manage your money. But as you go longer, that's why people say, think of long-term investing, because the longer you go out in investing, this starts to improve your rate of return. So look at this here. Just a 5-year rolling period in the stock market, you can see the highs are much higher than the lows are low, right? And the same is true as we go to 10-year and 20-year. So that's why I was talking about the 3 buckets, having a certain amount of money, maybe it's 1 or 2 years in cash, and then the other years are your medium to long term, and that way you can be long on, because you don't need all your money right away, and that way you can be long on your money and you can enjoy smoother returns as opposed to trying to time the market year over year. So I talked before about that retirement zone, the 5 years leading up to retirement and the first 5 years of retirement. You don't want to have severe negative returns. This is really important. Insight number 2, let's talk about risk versus reward. I always say that you should get a financial plan. It's almost on every single video of mine. And why do I have such a conviction about this? Because if you can see the outcome of your planning decisions before you commit to them, then it's kind of like having, hindsight is 20/20. It's this mentality that you're able to actually see what kind of outcome you would have if you had done this way or gone that way, if you put this amount of money in at this rate of return, if you do this withdrawal from this account first. How do you go about figuring out what is the best path for you? And the only way to do that, I believe it 100%, is to ask an advisor to give you a financial plan. Now, a financial plan is not time value of money. A financial plan goes into, yes, deposits at a certain rate of return, but it's also about the withdrawals. Where do you take the withdrawals from? Which accounts do you take out first? Do you take CPP first, or do you defer CPP? Do you downsize your house? Can you do an RSP meltdown? All these things go in a financial plan. So this is why I think it's very important that you get a financial plan. What are your return expectations? When you look at this is actually from the financial planning software that I use, and you say, look, does your financial plan say you need 12% in order to retire? Or is it 4 or 5% or 3%? What is the rate of return that your financial plan says, if you get this rate of return throughout your retirement, you will not run out of money. You'll have enough money to fund all of the goals that you've asked, hey, we want to do this, this, and this. And you put a rate of return and the software says all you really need is this rate of return. Then you have to ask yourself, do you really need more than what your financial plan says? If you want more, then you're going to have more money, but you have to see that you don't need it. So it's unnecessary risk. So when we go back to risk versus return, are you going after the highest return because you just want to go after the highest return? Or do you want to hit a return that is actually the return that you need in order to have sustainable income throughout your retirement? Insight number 3, let's talk about diversification. This is really easy. Don't put all your eggs in one basket when it comes to investing. Spread your money across different types of investments. Having a wide range of equities and fixed income is a smart thing to do. You've heard of 60-40 split. This is a balanced type of split. Balanced investors, not 50-50, it's 60-40. But understanding how to invest your money in a way that doesn't add risk to your portfolio but still gets you the rate of return you need by spreading your money across different asset classes is a wise thing to do. And Warren Buffett says the 3 most important words in investing are margin and safety. You get that by 2 ways. Do a financial plan that tells you what's the rate of return you need in order to achieve your financial planning goals. And then the next thing is you get a portfolio review done. Ask another advisor. Could you have a look at this portfolio? Give me some of your thoughts on what you think I should be doing with my money. And they'll give you, hopefully they give you an honest opinion. They'll just put their notes on that portfolio and send it back to you, or they'll email you some notes. I do that, or sometimes I do a video review of the portfolio so you can actually see me doing the review and talking with you about what I think you ought to do. They're free, so it's a wise thing for you to do. Just get a second set of eyes on your portfolio. Let's look at just a couple insights as to what I see a lot in portfolios. So these are like the top things that I see that could be a problem. One is, being overweighted in one particular sector. So you see here on the top left-hand corner, this person's portfolio, 54% invested in financials, and then virtually nothing else. And so this is a problem. If most of your money, or 54% of your money, is in one area and that goes negative, you're having a bad day. And so that's not a good idea. So you do want to spread your money out a little bit more wide so that not one particular sector is going to wipe you out. Talking about countries, if you're in Canada, then, and I've said in other videos, if you're risk adverse, if you really don't like risk all that much, then just stay in Canada, because you're going to avoid 97% of the world's problem, because Canada's economy is 3% of the world GDP. So this person has 70% of their money in Canada, and then 20% in the United States. Now, if that is a general philosophy that you might have, but you see that most of the returns are coming out of the US, then you might need to consider, what should I be doing? Should I stay in Canada at 2.5% rate of return, or should I maybe increase a little bit more my US position so that you get some improvement on your return? So that is some of the discussions you have with your advisor about how do you feel about increasing the allocations and the risk and so on. Well, here's another one. When you look at this is actually what you would see in a portfolio review. You'd be able to look at what is the actual allocation. So you have Canadian equity, 41%, as an example, okay? 41% in Canadian equity, 30% US equity, 23% international equity, and then so on. So you see this is actually spread out throughout different equities, Canadian and US and international. And then you look at the right-hand side and you say, okay, well, what is it invested in? You say, well, 37% is in cyclical investments. Yes, there's 21% of that 37%, 21% happens to be financials. And then you look at where else the money is invested. So it's actually spread out very well. The sensitive area of the economy, 44%, 20% of that 44% is in technology. And so we saw the NASDAQ go up, right, all year long. And if you're mostly invested in financials and not really technology, you're not taking advantage of where the returns are actually coming from. Let's talk about the correlation matrix. This is something you should be doing right away. Have this done in a portfolio review, because it reveals correlated investments. What you want is the lowest correlated investment portfolio you can get, because what it does when you do that is you get lower fees, a higher rate of return, and lower risk. And so let me walk you through how this works. It's super easy to do. If you're not getting it from your advisor, let me know. I include it in all of my portfolio reviews, and they're absolutely free. Imagine that these are your 8 funds, okay? We're going to compare the stocks and bonds in one fund to see if they're present in any of the other funds. So if you look at the vertical axis here, fund number 3 has 0.90. That means 90% of the stocks and bonds in fund number 3 are also in fund number 2. And fund number 8, 93% of the stocks and bonds in that fund are also in fund number 3. This is one of the most powerful reasons why you'd want to get a portfolio review, to lower this correlation in your portfolio. Insight number 4, let's talk about rebalancing. What does it mean to rebalance? When you have a certain allocation to financials, energy, technology, healthcare, and so on, and you see that one of those areas has gone up much faster than the other areas, then it might be time to rebalance. So have a look at this. Technology, as you know, went up tremendously so far in the year, and that means that the portion that you have allocated to technology might have ballooned on you. So if you look at it from a visual point of view, if your portfolio led with financials and then technology and then energy, but we saw technology lead the way, now all of a sudden technology is ballooned and financials is much lower. So this is where if you really wanted to have a portfolio with one sector here and there, then you need to rebalance to make sure that that type of allocation is always being maintained. Pretty simple stuff. Insight number 5, let's talk about contributions and withdrawals. I've said very, very often that most people have a contribution strategy and don't have a withdrawal strategy. You're focused on putting that money in every single year, getting the tax deduction, but you're not really focused on, well, I'm going to take the money out this way or that way. You'll deal with that later on. But actually, that's probably the most important part of investing is how you withdraw your money. So I would say begin with the end in mind, but I don't want to get ahead of myself. Let's look at this slide. This will help you to see what we're talking about. We're talking about this relationship between income and savings. As your income rises, you also want to increase the amount going into your investments. So if you were to begin doing that, you can see that blue line is a 3% contribution rate. And the person never increased even despite the fact that their income went up each year, they never changed their deposit going into their investments. And you can see how much money they have there. And then you look at the person who does the green line, and so they increase by 1% annually from 3% up to a maximum of 10%. So every year they increase their deposit from 3% to 10%, but only increase it by 1%. So even though their wages went up 2.5%, they only put 1%. So they're not actually putting their full wage growth in there. And you can see they actually have much more money, $2 million now. Then the person who says, look, I'm just going to consistently put 10% contribution in. And so what happens? They have 2.2 million. So when you look at the difference between the escalating and the consistent 10%, there's not much of a difference. So if you decided I'm just going to do 10% all the time, and it was really hard to do when you had a $50,000 income and it's only going up by 2.5, but you're increasing by 10, you might feel kind of a squeeze with your money. But if you're only increasing it by 1% per year and you just do that consistently until you get to 10%, then that would be a remarkable amount of money that you have. And it's only because you're adding money as you're earning money, you're adding a little bit more to your savings. And that's a powerful way to save money to make sure you're going to have more than enough money to retire. And pretty simple to do. And you won't even notice it, by the way, when you do that. Let's talk about dynamic withdrawals. This is for some people who have, especially who have tax-free savings account, large balances, and non-registered account balances. When you have a minimum withdrawal, RSP or RIF, you can't do this because you can't really go down further than the minimum. But if you had a larger non-registered account and a TFSA account, but you were doing withdrawals out of that, this is where you get to control your withdrawal. So when you have high inflation and low returns and you don't need to do the withdrawals, then stop doing the withdrawals or lower the amount that you take out. That way it'll extend the life of your portfolio well into your golden years. Because as we said in the previous slide, where when you have negative returns and you're doing withdrawals, it accelerates the rate at which your portfolio goes to zero or declines. So if you're in a position where you can actually slow that decline by just simply reducing the amount that you withdraw or stopping the withdrawal, then that will extend the performance of your portfolio and extend that timeline much further. So now when you connect the dots of this fifth strategy about how to do contributions and how to do withdrawals, I'm really big on the 3-bucket strategy. You can call it whatever you like. Essentially what it means is that you have one bucket that is in cash or GICs or high interest accounts, and that's supplying the expenses for a period of time that you believe you would be feeling more confident just being in cash. So is it 6 months, a year, 2 years? Only you can answer that question. But you essentially would do all your withdrawals out of that account. The middle bucket and the third bucket you see on the screen, the middle bucket is medium kind of returns. You're not doing anything too aggressive here. You might be doing a 50-50 split fixed income equity, maybe 40-60, depends on your risk tolerance. But what that bucket does is it supplies or replaces the cash bucket when that depletes. So as you get to a point where that cash bucket is depleting, the middle bucket the return from that middle bucket is supplying the cash required for the next year or 2 years or 6 months, whatever that timeline was. So that's the rate of return that you need to work out, is what is the rate of return that's going to restore your cash bucket in the timeline that you've set out. And the third bucket is just longer returns, maybe more equities, more risk involved there, because it's going to supply the money that you're taking out of the middle bucket. It's going to replenish the middle bucket. So it's this sort of waterfall effect, longer returns, spreading the risk out longer, water falling down into the middle bucket and then down into the cash bucket. It's a really simple strategy. It works for a lot of people. You'd imagine in 2008 when we had the worldwide financial crisis. Do you remember what that was like? Everybody was panicking, and it was really hard to deal with. And people were retired in Florida, the snowbirds, and a third of their income was dropping, right? So they were in Florida. They thought, hey, we're going to be here for 5 months. This is going to be our income stream. And all of a sudden their RIF payments dropped by a third. Really frightening. Much easier to say, if we have the next 6 months in cash, doesn't matter what's going on in the market, because actually in 2008, after 6 months, the market actually come up 50%. So if they had their money just 6 months in cash, wouldn't matter what was going on in the market. They had their spending taken care of, and they would have been unnerved by what was going on in the market, but time took care of that, right? Well, that's it for today's video. I hope you enjoyed it. Did you get a lot out of this video? Put your comments below. I love to see your comments. And also, if you did get a lot out of this video, smash that like button and share this with anybody you think needs to see this video, because I really think this is great information. This video had a lot of really good nuggets in it. It was a little bit longer, but I like taking my time on some of these strategies that really you have to explain really well. So if you did appreciate that, I'd love to hear your feedback on it. I always end every video by saying we take care of your wealth management so you can take care of what's most important to you. There's my contact information. It was great to see you again, and I look forward to seeing you in the next video. Thanks and take care.